All right, buckle up because what we're about to deep dive into today could absolutely transform your financial future. We've crunched the numbers, sifted through the data, and we're exposing the ultimate secrets to monthly income.
Whoa, hold on there.
You won't believe what we uncovered: the absolute best monthly dividend ETFs for 2025 and one dangerous yield trap you must avoid at all costs. This is insane.
Okay. Before we reveal these game-changing insights, a quick but critical note. You're with Channel Vest, this is your analysis.
That's right.
But please remember, everything we share here is for educational purposes only. It is not financial advice.
Yeah.
Always, and we really mean always, consult with a registered financial advisor before making any investment decisions.
Definitely.
Our research, was conducted with assistance from powerful AI tools, but it's designed to inform, not instruct.
Got it.
Got it. So today, we're cutting through all the noise to bring you the top monthly dividend ETFs for 2025. We're talking predictable income streams, incredible yields.
And how to spot the difference between, like, a golden opportunity and a portfolio-destroying mistake. Stick around because you absolutely do not want to miss the revelations coming up. So let's kick things off. Why are monthly dividend ETFs such a hot topic right now, looking ahead to 2025?
Yeah, good question.
It seems to be all about the current landscape, right?
Yeah.
Elevated market volatility. That seems to create perfect conditions for strategies focused on income.
Exactly. And then you've got these attractive yields. I mean, some reaching up to an incredible 10.5%. That's a pretty compelling alternative to traditional fixed income, wouldn't you say?
Absolutely. And finally, the holy grail for so many people, regular cash flow, just creating those predictable income streams for your investment.
Right. Predictability is huge. But here's the kicker. Not all monthly dividend ETFs are created equal. Not even close. Some are absolute winners, truly stellar performers that can, really bolster your portfolio, while others, well, let's just say some are dangerous yield traps that could seriously undermine your hard-earned capital. It's a jungle out there, and we're going to give you the map.
I like that.
And this raises an important question. How do you choose wisely? It's not just about the shiny number, that big yield percentage.
Right.
It's about sustainability and quality. And that's exactly why we're here to dive into the top P5 monthly dividend ETFs that truly deserve your attention in 2025.
Okay, let's do it. But before we unveil our rankings, maybe we should look at the raw numbers first, the current yields of our top contenders.
Good idea. Let's set the stage.
We're talking various percentages here, right? Which, on the surface, yeah, they might look tempting, but hold on a second. This is where it gets really interesting.
It does. Because what's fascinating here is that while yield is, a fantastic starting point, it's far from the only factor, like not even close.
Right.
The sustainability of those distributions is what really matters for long-term investors. A high yield today means nothing if it evaporates tomorrow. Poof, gone.
Yeah, it takes your capital with it.
Exactly. So we're going to break down each ETF to see which ones deliver the best combo of yield and equality.
All right, brace yourselves. Our hashtag one pick, the clear winner, is the JP Morgan Equity Premium Income ETF, or JPI.
JPI, yeah. Solid choice.
This fund is crushing it with an 8.65% current yield, boasts a massive $40.77 billion in assets under management. That's AUM, basically how much money they manage.
Huge amount.
And an incredibly competitive 0.35% expense ratio, super low cost. But the real question is, WHY is JTI the gold standard? Let's unpack this.
Okay, so JPI truly sets itself apart. It combines, institutional-grade portfolio management with a systematic options overlay strategy. Sounds fancy, right?
A little bit.
Basically, they actively manage it. They pick value-oriented large-cap stocks from the S&P 500.
Okay.
And then they use these things called equity-linked notes, or ELNs.
ELNs.
Right, to replicate covered call exposure. It's a smart structure.
Sure.
Its competitive advantages are pretty clear. Superior risk-adjusted performance. But look at the Sharpe ratio. It's 0.186.
Higher is better there, right?
Yeah.
Better return for the risk.
Exactly. Better risk-adjusted returns. Plus, quality holdings like Meta, Oracle, Microsoft. Big names. And get this, an impressive 13 consecutive years of monthly distributions.
Wow, 13 years straight.
Yeah. Morningstar even gives it a bronze medalist rating. They highlight its unique structure, how that options income can count toward dividend yields, not just capital gains. This is next-level stuff.
Okay, so the ELNs help turn options income into dividend yield. Can you simplify that just a touch? And also, you mentioned risk management. What truly sets JPI apart there? Because protecting capital is huge.
Absolutely. Okay, simplifying the ELNs. Think of it like, instead of JPI directly messing with lots of individual call options, They use these ELNs as a sort of package deal.
Oh, okay.
It gives them that options income stream more efficiently, helps boost the yield. Now, risk management. This raises an important question. How does it handle market turbulence?
Yeah, exactly.
Well, JEPI demonstrates a beta of 0.88.
Okay, what does beta mean again?
Beta measures volatility relative to the market. So 0.88 means it has about 12% lower volatility than the broad market during big swings.
Nice. Less bumpy ride.
Pretty much. And get this, during that infamous March 2020 crisis.
Oh, yeah.
And the market tanked.
Oh, yeah. Don't remind me.
JPI declined only 18.3%. Compare that to a staggering 34% drop for broader markets.
Wow, that's a huge difference.
It really showcases its adaptability to market stress.
Yeah.
And its value at risk, or VIR. Yeah, value at risk. It estimates potential loss. JEPI's is significantly lower than competitors at 1.52%. It's a testament to the risk mitigation from that covered call strategy. Truly a champion.
Okay, impressive stuff from JEPI. Are you ready for our hashtag 2 pick?
Let's hear it.
It's the JP Morgan Nasdaq Equity Premium Income ETF, or JEPQ. This one comes in with an incredible 10.5% current yield, the highest on our list.
Whoa, 10.5.
Yeah, it manages $28.88 billion in AUM and also has that competitive 0.35% expense ratio. However, while it offers that insane yield, it also comes with additional risks you need to understand. Stick around.
Right. So JEPQ uses the same successful covered call method as JPI, but with a crucial difference. It focuses on NASDAQ 100 technology stocks.
Ah, the tech focus.
Exactly. That higher 10.5% yield reflects the increased volatility you typically see in the tech sector. More volatility often means more valuable option premiums they can collect.
Makes sense.
Its strategic position is clear. Strong tech focus, top holdings. NVIDIA at 9.59%, Microsoft at 9.04%, Apple at 7.38%, big tech names. So it benefits from those long-term tech tailwinds. But that options overlay still provides vital downside protection. And what's fascinating here is its current technical status.
Oh, what's that?
Its RSI, the Relative Strength Index, is at 38. That's kind of getting near oversold territory, and it's trading about 3.2% below its 50-day moving average. So it might present a compelling near-term opportunity.
Interesting timing aspect there. But with that incredible 10.5% yield, there's got to be a trade-off, right? You mentioned risks, higher reward, but also higher risk. You won't believe the difference in market sensitivity compared to JEPI.
Absolutely. There's always a trade-off. The primary risk here is its technology concentration, nearly 46% allocation. That gives a growth tilt, sure, but also makes it vulnerable to sector-specific downturns.
Right, all your eggs in one basket, kind of?
Sort of. And it also has higher volatility. Its beta is 0.95, much closer to the market's volatility than JEPI's 0.88. And its VR is 1.90% higher risk exposure.
So more sensitive to market swings.
Definitely. It's a clear risk-reward trade-off.
Yeah.
The higher yield is there to compensate for that extra volatility. It makes it suitable, potentially, for more growth-oriented income investors.
Okay.
JEPQ is really ideal if you want that heavy technology exposure, but still want to generate substantial monthly income.
Got it. Moving on to our hashtag 3 pick, the Amplify CWP Enhanced Dividend Income ETF, or DIVO. This one has a 4.57% current yield, manages $4.75 billion in AUM, and a slightly higher 0.56% expense ratio.
DIVO, yeah. Different approach here.
And get this, DIVO's tactical approach has delivered incredible 2025 performance. You won't believe the numbers.
It's been on a tear. DIVO employs a tactical covered call strategy, but it's different. It's on a much more concentrated portfolio, just 20 to 25 large cap dividend growth stocks.
More focus.
Very focused. Its active management allows them to be opportunistic with the option writing, reacting to changing market conditions, and the performance highlights are stellar, an outstanding 37.95% YTD return in 2025.
Wow, almost 38% year to date. That's huge.
It really demonstrates effective tactical implementation. Plus, it has a strong focus on quality, emphasizes dividend aristocrats, companies with sustainable payout ratios. And that covered call strategy provides the cushion during declines.
Okay, sounds good. Any downsides?
Well, its smaller size, the $4.75 billion AUM, might limit position sizes for really large institutional investors. Something to keep in mind.
Right. So DIVO's exceptional 2025 performance, nearly 38% YTD, that's created both opportunities and challenges, hasn't it? This is where active management really shines, but you need to know when to make your moves.
Indeed. Timing is interesting here. Current technical status actually shows overbought conditions. Its RSI is 72.
Over 70 is usually considered overbought, right?
Generally, yeah.
Yeah.
And it's trading almost 9% above its 50-day moving average. So this might suggest trimming positions if you bought lower and have significant gains.
Okay, so maybe take some profits.
A smart profit-taking strategy could be to consider realizing some of those gains. Maybe redeploy into something that looks oversold, like we discussed with JEPQ, perhaps, for better entry points elsewhere.
Makes sense.
For long-term allocation, maybe maintain a 10–15% position for that tactical flexibility DIVO offers, but probably avoid overconcentration due to its smaller AUM and that slightly higher expense ratio.
Good advice. Now for our #4 pick, a true dividend powerhouse. The Schwab U.S. Dividend Equity ETF, or SCHD,
Ah, SCHD.
the benchmark.
Exactly. This one has a 3.76% current yield, a massive $71.02 billion in AUM, and an unbelievably low 0.06% expense ratio. Just incredible.
6 basis points, practically free.
Now, SCHD pays dividends quarterly, not monthly, but we had to include it. It's the absolute benchmark for quality in dividend ETFs. This is insane.
Yeah, SCHD's inclusion is crucial because it really is the benchmark. Its passive approach tracks the Dow Jones U.S. Dividend 100 Index, focuses on companies with a history of 10-plus years of dividend payments.
Solid track record.
Very solid, and its fundamental strengths are compelling. First, those ultra-low costs, that 0.06% expense ratio, gives it a huge advantage over time.
Second, rigorous quality screening. It looks at things like cash flow to debt, return on equity, ROE, dividend sustainability.
So it's not just about yield, it's about financial health.
Precisely.
Yeah.
Ensures those dividends are likely to stick around and grow. And it boasts a great long-term track record. 12.47% annualized return since inception. If we connect this to the bigger picture, it just hammers home the importance of cost efficiency in dividend strategies.
Yeah, you might think 0.06% doesn't sound like much difference compared to, say, 0.35%, but when we look at the expense ratio versus performance over the long haul, SCHD truly stands out. This is where long-term wealth is built.
Oh, absolutely. What's fascinating here is how SCHD's minimal fees combine with those strong long-term returns. Small fee differences compound significantly over time, like massively. It makes a huge impact on your total wealth down the road.
It really adds up.
It does. Its superior risk-adjusted profile, combining minimal fees with solid returns, really drives home the message. Cost efficiency is paramount for long-term dividend investors. Can't ignore it.
Well said. And finally, for those prioritizing stability, our #5 pick. Rounding out our top 5 is the Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD.
SPHD, the defensive play.
Exactly. This ETF offers a 3.33% current yield, manages $3.50 billion in AUM, and has a 0.30% expense ratio. SPHD is the defensive specialist for investors who prioritize stability above all else. You won't believe how it shields your portfolio.
Yeah, SPHD's strategy is pretty specific. It targets the 50 lowest volatility, highest yielding stocks from the S&P 500.
Low vol, high yield. Makes sense.
It's a systematic approach designed to significantly reduce portfolio volatility compared to other high dividend strategies.
Smoother ride.
Its risk management focus includes sector diversification with strong exposure to utilities at nearly 18% and consumer staples around 15%.
Defensive sector.
Exactly. Sectors known for stability. Plus, it does a semi-annual reconstitution, basically rebalances twice a year, which maintains portfolio discipline.
Okay, so who is SPHD really for?
It's ideal for conservative investors. Those who prioritize capital preservation over getting the absolute maximum yield. Its defensive sector allocation provides a crucial buffer during market turbulence, a solid choice for risk-averse income investors.
Okay, great stuff. 5 really strong contenders there. But wait, before you invest, there's one ETF you should avoid.
Uh-oh, here it comes.
Okay, so we've given you 5 incredible options, but now it's time for the big warning. Wait, before you invest a single penny, there's one ETF you absolutely should avoid. Let me show you the dangerous yield trap that could destroy your portfolio. You won't believe how many investors fall victim to this.
There's such a critical point. Seriously, listen up. The ETF to avoid is SDIV, the Global X Super Dividend ETF.
SDIV, got it.
SDIV is a classic textbook example of a yield trap. Despite an initially attractive, 10.91% trailing yield.
Wow, that sounds good on paper.
Sounds good, right?
Negative. So you lose money overall.
Yes. Investors receive high current income, but it comes at the expense of their principal. You're essentially paying yourself with your own money while the investment shrinks.
That's terrible.
It gets worse. There are major quality issues. It tends to concentrate in distressed companies where those super high yields often indicate financial distress, not strength. Red flags everywhere.
Okay.
And finally, significant geographic risk. Heavy exposure to emerging markets, commodity-dependent economies. That adds a lot of volatility and political risk. Morningstar even gives it a low process pillar rating, citing weak long-term risk-adjusted performance and inadequate quality screens. Just stay away.
Wow. Okay, that's a crucial warning. So this is vital knowledge. How can you, listening right now, spot these dangerous yield traps like SDIV before they damage your portfolio? We're giving you the cheat code.
Right. This raises an important question for critical thinking. What are the red flags? What should you look out for?
Yeah, what are the signs?
First, look for unsustainable yields. Anything consistently above, say, 10% often signals underlying business distress. Be very skeptical.
Okay, super high yield, caution.
Definitely. Second, check for poor total return. If you see high current income, but the fund's value is steadily declining over time, run away. That's wealth destruction, not income generation.
Got it. Total return matters.
Hugely. Third, be wary of quality deficiencies. Look for funds that lack fundamental screens for things like dividend coverage, free cash flow, balance sheet strength. Quality matters.
Makes sense.
And finally, watch out for high turnover. Extreme portfolio turnover, like SDIV's 22%, just erodes returns through transaction costs. It often means they're chasing yield frantically.
Great tips. Unsustainable yield, poor total return, lack of quality screens, high turnover. Watch out for those.
Exactly. Your portfolio will thank you.
Let's shift gears slightly and look at how these ETFs spread their bets across different sectors. This reveals significant style differences, right? Which is vital for diversification.
Yeah, the sector allocation analysis is fascinating. You see big differences. JEPQ, as we said, has that huge 45.8% technology allocation, big growth tilt.
Right.
Then SPHD leans heavily into defensive characteristics, 17.2% utilities, almost 15% consumer staples.
The stability play?
Yep. SCHD offers a more balanced allocation across sectors, though it does have a notable emphasis on financial services at about 23%.
Okay.
And JEPI. It actually stands out with the most balanced sector allocation among these, I'd say. It cleverly avoids overconcentration in any one area.
Good diversification within JEPI itself.
Yeah, seems that way.
Okay, now for the numbers that truly matter when you're weighing options, how do these ETFs stack up in terms of risk-adjusted performance? This is where you said JEPI really shines.
It really does. If we connect this to the bigger picture, like looking at a risk-return scatter plot, you'd see JPI positioned optimally in that upper left quadrant.
Upper left meaning?
Meaning it combines above average returns, about 7.3% historically, with below average volatility, around 15.2%, getting good returns without excessive bumps.
The sweet spot.
Kind of, yeah. Its Sharpe ratio, remember that measure of risk-adjusted return?
Yeah.
It's 0.186, significantly outperforming these peers.
And the others. Quickly.
JEPQ is actually negative right now, negative 0.142, likely impacted by recent tech underperformance in 2025. DIVO is 0.051, but has limited history.
Yeah.
And SPHD is 0.129 decent, reflects its defensive nature, but comes with that lower yield.
So JEPI really stands out on that risk-return metric.
Clearly underscores its strength, yeah.
Okay, before we move into how to integrate these into your portfolio and our final recommendations, if you're finding this deep dive valuable, please do us a huge favor. Hit that subscribe button right now. Turn on notifications.
Yeah, click it.
You don't want to miss our next video. You're with ChannelVest. This is your analysis, and we've got so much more coming. All right, you've got the knowledge. Now let's talk strategy. How can you actually incorporate these monthly dividend ETFs into your portfolio? We've got 3 approaches, depending on, where you are in life.
Right, let's make it practical. We broke it down. For conservative income portfolio, maybe think ages 60 plus, seeking stability.
Okay.
A suggested allocation might be something like JGBI 40%, SCHD 30%, JGPQ 10%, DIVO 10%, SPHD 10%. That aims for about a 6.4% combined yield with a lower volatility beta of 0.84.
Conservative makes sense. What about balanced?
For balanced growth portfolio, maybe ages 40-60, still in the accumulation phase, consider JPI 30%, SCHD 25%, JGPQ 20%, DIVO 15%, SPHD 10%. That gets you a slightly higher yield, maybe 6.65%, same 0.84 beta, balancing growth and income.
Okay, and if someone just wants maximum yield?
For a high yield focus, where income is the absolute priority, maybe JPI 35%, JPQ 25%, getting more of that high yielder, SCHD 15%, DVO 15%, SPHD 10%. There's definitely more risk. And remember, these are just starting points examples. Always consult with a financial advisor to tailor allocations to your specific situation, your risk tolerance, your goals.
Crucial disclaimer there. This is insane how much you can customize, though.
Totally.
Knowledge is power, but protection is paramount. Let's talk about advanced risk management and then our final actionable recommendations. You won't believe the difference these strategies can make.
Absolutely. Protecting the downside is key. First, consider position sizing limits. Don't put all your eggs in one ETF basket, even the good ones. Maybe set maximums like JEPI 25% max, SCHD 40% max, it's a core holding.
Yeah.
JEPQ 20% max, DIVO 15% max, SPHD 15% max. Just examples, but have limits.
Good discipline. What else?
Implement a stop-loss framework. Decide beforehand at what point you'd sell if an ETF drops significantly. These levels might vary based on the ETF's volatility, maybe a 15% stop loss for JPI, maybe 20% for the slightly more volatile SCHD.
Yeah.
Having a plan before things go south is key.
Removes emotion. I like it.
Exactly. And set rebalancing triggers.
Yeah.
Don't let one position grow wildly out of proportion. Maybe rebalance back to your target allocations when any position drifts more than, say, 5 to 8 percentage points away from its target. Keeps the portfolio aligned with your strategy.
Smart. Okay, final recommendations. Let's hear them.
All right, based on all this, strong FI on JEPI. We think it's a core holding, target maybe 25–30% allocation. An ideal entry might be below $52.50 if you can get it.
Strong by JPI.
JEPQ. We see it as a tactical opportunity right now, especially if you can get it at $48.80 or below, given those oversold conditions we mentioned.
By JEPQ. Tactical. Got it.
Hold SCHD. It's your core quality dividend holding. Suitable for 30–40% allocation long-term? Just hold and let it compound.
Hold SCHD. Makes sense.
For DIVO, a tactical buy Y. We mentioned profit-taking might be wise now after its run-up, but maybe maintain a 10–15% allocation for that tactical flexibility it offers.
Tactical by DIVO.
Okay, and finally, hold SPHD. Keep it as a 10–15% allocation for stability and that defensive buffer in the portfolio.
Hold SPHD. Fantastic. Yeah. That's a really comprehensive approach, like how the pros manage their portfolio.
That's the goal. Income plus protection.
Love it.
As we wrap up this deep dive, though, we leave you with this big question. In a world of, potentially rising interest rates, ongoing market volatility, are monthly dividend ETFs still the absolute best income strategy? Or should investors perhaps be considering alternatives more seriously now, like high-quality bonds or maybe dedicated dividend growth stocks? What's your take?
Oh, that's a good question to ponder. Seriously, we want to hear from you. Comment below with your thoughts. What are you doing for income? Let's keep this conversation going.
Yeah, let us know.
You've just gotten a massive shortcut to being well-informed on monthly dividend ETFs for 2025. Hopefully, this arms you with the knowledge to navigate the market ahead. Until next time, keep learning, keep growing, and thanks for deep diving with us.